Welcome to our webinar, Be the Bank, Private Lending with a Self-Directed IRA Account. My name is Larissa Greene, and I'll be talking to you today about different ways we see our clients private lending through their qualified plans. So we're going to talk about IRAs and HSAs, and we're going to touch on different types of private lending with a retirement account. We're also going to talk about how an IRA or qualified plan can borrow to purchase real estate and sort of the moving parts that go along with that type of transaction. Again, my name is Larissa Greene. I've been with Advanta IRA since 2011. I do business development, but prior to that, for a few years, I did check coding, transfers, opening new accounts. I did a few transactions, and probably about 10 years ago, I moved over to business development where I've done some marketing, sponsoring events. I do a lot of networking for the company, and I help people establish their self-directed plans. My contact information is here, but if you have any questions, I'm happy to answer any questions as we go. Please type them into the question box and I will be checking that periodically. I also did upload the slides for your review. They're under handouts as a PDF, so if you'd like to download those and save them, take notes, they are under handouts in the handout section of your navigation. Keep in mind, although today we're going to talk a little bit about the rules for self-directing an account, how the IRS views these types of accounts, and what you're allowed to do within them, we do not provide investment tax or any legal advice. So that's really important to understand. And going forward, if you have any questions, certainly ask them. But if it's something we can't answer, we're going to let you know, hey, that might be a question for your accountant, for your legal team. If you don't have somebody to turn to, we might have some professionals that we can refer you to that have helped our clients in the past. So just remember, all information and material is for educational purposes only. A lot of times when we start talking about the rules, things you can and can't do, and different investment structures that we've seen, it gets to be a lot of information. And so just keep in mind that there are really some just key takeaways that I want you to focus on for today's presentation. So any IRA or former employer plan qualifies. You choose the investment, so Advanta doesn't sell you anything at all. We provide a service for record keeping for your retirement plan. So you choose the investment, and then all expenses are paid by the IRA and any income is received by the IRA. And these are really the three most important points that I hope you'll walk away with today. And anything else that you have questions on, you can always reach out to us, but we're just really trying to help you with the idea of different investment strategies for your self-directed IRA so that you can truly diversify and make those investments that you know best. I'm going to talk a little bit very briefly about Advanta, again, what we do. We'll also talk about a self-directed IRA and the different types of accounts that you can hold with Advanta and self-direct. We'll go over private lending basics, and then I have examples for you. And remember, we're not just going to talk about a typical mortgage today. We're also going to talk about different ways we see private lending happen within qualified plans. Advanta IRA has been in business over 20 years, actually 21 years this month. And we are not just in the Tampa Bay area of Florida, but we can help anybody anywhere. We also do have an office in Atlanta, Georgia, but if you have a US-based retirement account, we can help you self-direct that. And even if you live outside of the US, again, a US-based retirement account can be self-directed. We don't sell any investments at all. We simply hold investments outside of the market. So we can't help you with stocks, bonds, and mutual funds that are market-based, but we can help you with private stock, gold and silver bars and coins, limited partnerships, and really the list goes on and on. And we have almost $3 billion in assets under management. And something that really makes us stand out from our competitors is that every single one of our clients is going to receive personalized service. Everyone has a dedicated account manager, somebody to assist them with questions, just simply from making an annual contribution, which a lot of people are doing right now, all the way through to any investment that they're looking to make. And so that person is with you for the life of the account. And I really think that makes us stand apart from our competitors in this industry so that you're not just calling a phone number, trying to get in touch with somebody and having them review your account every time because they're just unfamiliar with your transactions. So that doesn't happen at Advanta with a dedicated account manager committed to your account. So what is a self-directed IRA? We often hear people say, well, I have a self-directed IRA with my brokerage firm. I'm allowed to choose from a list of investments that they provide. But our definition of a self-directed IRA is something much different. We are truly talking about finding an investment outside of the market, bringing it to us, and then if you can do it in an IRA, we're going to help you get it done. We help you make sure that the IRA is properly titled to show this is an investment of a retirement account and not a taxable event. And then we have you approve the documents and any investment documents, and then we help you make the investment and do the record keeping. A lot of brokerage firms aren't going to hold these private investments. And I feel like it used to be that we would see a handful of them hold specific private investments. So like investments into private stock or something like that. But they really turned away from that at this point. We actually even had some clients referred to us by some brokerage firms where they just simply couldn't hold those private investments anymore. They don't know how to value them. They don't know how to do the record keeping, receiving income on those assets, or even maybe pay an expense on behalf of an investment that would be considered privately held. And although the IRS has always allowed this much broader range of investments, there's just simply not a lot of companies out there like Advanta willing to hold private investments. If you came in late, I just want to remind everybody questions can go into the question box. I'm happy to answer them as we go. And these slides are loaded as a PDF handout under the handouts box in your navigation for GoToWebinar. We're going to talk a little bit about the types of plans and assets that we see in self-directed accounts. Oftentimes people will say to me, well, I don't have a Roth IRA, so I can't self-direct it. I can't invest in real estate because it isn't Roth. And I'm not really sure where that comes from, but if it ends in IRA, it can be self-directed. So you have traditional IRAs. Of course, those are the most common types of plans we see. Those are accounts for individuals. They're not employer-based, but oftentimes they're funded from like an old employer plan. So if you work somewhere, maybe in another lifetime, and they were making contributions for you to a 401k, all that money was pre-tax, and then you left that employer and rolled that over to an IRA, you typically would go to a traditional IRA because it is a pre-tax account, and typically a 401k is pre-tax money. And so moving money in that way is not going to have a penalty. It's not going to be taxed. And so therefore we do see a lot of traditional IRAs. These are great accounts because they're pre-tax, and so you typically get a deduction for making your contribution. You kick the tax can down the road. And yes, at retirement age, you are going to pay taxes, but only on the amount you distribute the years that you take distributions. At some point, the IRS is going to require you to take a little bit of money out. It's going to be a little bit over your lifetime, but you can still continue to grow a traditional IRA. So that's really good news. And if you like to get deductions on your taxes, that might be a great account for you. A Roth IRA is an after-tax account, so different than a traditional IRA. You're putting money in without a deduction on your taxes. It's whatever you considered ordinary income for that year, but then that contribution goes in after tax and it grows tax-free. Only two things have to be true for the Roth IRA to be completely tax-free at retirement. You have to reach age 59 and a half, and your Roth IRA has to have aged for a minimum of 5 years. And as long as those two things are true, then those distributions will be tax-free. The only exception to that would be if you had done Roth conversions at some point. We're not going to talk about that today, but we do have webinars on Roth conversion. So if you'd like to learn more, you can visit our video archive on our website or go to our YouTube channel and find those webinars there. We also do hold simple IRAs and SEP IRAs. These are plans for small companies or small businesses. They can also be for sole proprietors. So if you have self-employment earned income and you'd like to start a plan as your own employer, you can have a SEP or a simple. These plans also work with small businesses with employees, and you can make contributions to your self-directed account. And for your employees, they can either self-direct or they actually don't have to. They can go with a brokerage account if they're not familiar with self-directed IRAs. So those plans are very flexible. We also hold solo 401ks, and solo 401ks again for the independent business owner, sole proprietor, and their spouse only. This one will not work if you have employees, where you can make contributions both as your own employer and the employee of the company and really max out those contributions. We can help you with any former employer plan. So once you've severed ties with the employer, they actually have to allow you to roll it into an IRA, so you can move that to a self-directed IRA. And then also up here, I have health savings accounts and education savings accounts. These are great accounts, and although not retirement accounts, they have tax advantages, and so they're considered qualified funds, and we can hold those accounts. The rules for self-directing them are going to be exactly the same as the IRAs, and so we can help you with that self-direction if you choose. So we're going to just talk a little bit about the different types of investments we see in a self-directed account, and then we're really going to focus on private money lending. Real estate, and of course, private lending is going to fall under real estate in many occasions, but not always. Sometimes people lend on different assets and businesses instead, and we'll get into that. But real estate, actually purchasing the asset, would be things like single-family homes for long-term or short-term rentals. It could be rehab projects. They don't have to be single-family homes. You can be interested in purchasing a condo for your retirement account. They could be mobile homes and mobile home parks. We see people purchase tax deeds, real estate investment trusts and syndications, and private placements that are investing in real estate. So basically pooling funds to make those larger investments. It could be commercial property and really any type of multifamily. So we see all kinds of real estate investments here, and really your strategy is your own. Now, when we talk a little bit about the rules, you're going to see where you really can't purchase a property to live in. This isn't your primary residence. This isn't your vacation home or your second home. This has to be an investment for investment purposes. And the same is going to apply to private money lending. And we'll talk about that in just a minute. Paper assets. So again, lending money, but you can also purchase tax liens, and I have tax deeds on here again. They could be unsecured notes. They can be debenture notes. We see people invest in option contracts for real estate. If you're unfamiliar with that strategy, we do have a webinar with a guest where he talks about option contracts. We see people deal with assignments and joint ventures, and also maybe a little more unique accounts receivable. And so there's a lot of different strategies under the paper side. So if you say, you know what, I don't want to deal with tenants, toilets, and termites, but I want to be invested in real estate in some way, there are a lot of options available to you. And even on our last slide where we talked about syndications and limited partnerships, you could choose to be a limited partner in someone else's deal and therefore be a very passive investor in a real estate deal, where you're just including your money into a deal that's on a larger scale to make an investment, maybe into a mobile home park or a multi-family property, something of that nature. There are some truly unique investments out there that we see in the self-directed retirement world, and then some a little more commonplace than you would think. So for example, investing into an LLC, and that could be investing into a third-party company or business, maybe some angel funding or startup funding for small businesses, and we do see that. But we're also talking here about investing into a single-member LLC for checkbook control. So that is something that we see. Farm animals, again, remember at Advanta, we say invest in what you know best. And we do have farmers come to us and say, hey, I know about raising cattle. I want to invest in cattle, alpaca. We have people invested in racehorses. And although these cannot be animals on your farm, you can make these types of investments as long as you're not responsible for their care and housing. We see people invest in partnerships and movie projects. Precious metals is another popular investment. So instead of investing on the market in something that would be considered like a precious metals fund, we see people invest in actually buying gold and silver bars and coins, platinum, palladium, and then having a depository store those metals under the name of the IRA. We've seen large equipment leasing and farm equipment leasing and transportation. Forex accounts or foreign currency trading is something that we've seen a lot of. And although there are platforms for Forex accounts or foreign currency trading, those platforms do not want to do IRS reporting. And so they leave it to us. So their clients come to us, open a retirement account with us, and then we help them get the platform in the name of the retirement account, and then they can do their trading from there. We have a lot of private stock, commodities, again, and oil and gas. And again, any of this, as long as it is privately held, because I know some commodities, some oil and gas investments might not be considered private, but as long as it's considered privately held, we can help with that. I did have a question pop up. What about purchasing property in a foreign country? For example, the UK. Yes, you can invest outside of the US. We do have clients that own property outside of the US in their retirement account. I actually do have a webinar on that. So if you go to our YouTube channel, you can find that archived there, or if you would send me an email and I will pull it up and email it over to you. But the most important thing here is when you're investing outside of the US, making sure that you know what country, the requirements of the country that you're going to invest in. So some countries require like the US equivalent of an LLC, for example, to be established in their country prior to making an investment into real estate, for example. That's something we've seen in the past. So just being aware of what that country is going to require for you to make that investment. Because remember, at the very beginning of the webinar, we talk about how Advanta doesn't do the due diligence for you. We don't give any legal or tax advice. And so when you're investing outside of the US, just make sure that you're working with a team of professionals that can help you understand what requirements you might need in order to make that investment. So money moves between retirement accounts pretty easily. There's a few different ways to do it, and the way that we do it is going to very largely depend on the type of account you have and the type of account you're moving to. So if you're moving from an old 401k to an IRA, that's considered a direct rollover, as long as you're not first taking a personal distribution. You do have to request the funds when it's from an old employer plan because they won't speak to us, but we'll give you all the information you need in order to do that. And then when the money comes over to Advanta, it's not taxable, it's not penalized. It just seamlessly goes into a like account. So if you have a pre-tax employer plan, then you're going to have a traditional IRA with us. We're going to help you with the information you need. You request the funds and money comes over. The other way to transfer money is literally by transfer. So we're talking about a trustee to trustee transfer here, where if you have an existing IRA and you're coming over to an IRA with Advanta, we're going to help you request those funds. It is not taxable. It's not penalized, and actually it's not even reportable. We add a letter of acceptance to a form we have you complete, and we request the money on your behalf. And then an indirect rollover is when you take a distribution from a qualified plan, whether it's a 401k, some type of employer plan, or an IRA, and you have 60 days to get that money back into a qualified plan. It is important to note that that 60 days is not 2 months. That is not the same thing. And I know that seems like something silly to mention, but I think time gets away from us. And so we start calculating by months instead of days. And so you just want to note that if you take a distribution, you have 60 days to redeposit those funds before it becomes a taxable event. So although it doesn't necessarily have to be a taxable event, it can become that. And I had a question pop up on how many times a year you can do a 60-day withdrawal, meaning an indirect rollover. That's just once. One time a year, and it's not one time in 2023 and one time in 2024. It's one time in a 12-month period. So just make sure you understand those rules and that you're talking to your accountant when looking at doing an indirect rollover, or basically a distribution and then indirect rollover. There are easier ways to move money where you don't have to worry about that 60 days. I had a question pop up on asking about foreign currency trading. You can fund a foreign currency trading account with an IRA. We do have clients do that. You essentially set up a self-directed IRA, fund that account, let us know who the Forex platform is that you're going to be working with, and we reach out to them. We help make sure that your profile is set up in the name of the IRA, and then we transfer money over there so you can do your trading. Okay, so self-directed IRA rules. We're just going to talk about this a little bit because it's important to understand what you can and can't do when it comes to your retirement account. We're going to talk and focus on private lending today, but there are a lot of different scenarios where this could become an issue and might be a prohibited transaction if you don't know how the rules work. The IRS allows almost any type of investment as long as it's for investment purposes. But you want to be careful here because there are two prohibited investments or two asset classes you cannot invest in, and that's life insurance and collectibles, so antiques, alcohol, artwork, stamps, and coins. And we did talk about gold and silver bars and coins. So some coins are allowed as long as their value is based on the trading value of the metal. And the IRS website does actually have a list of metals that you can invest in, so you can check that out if you're interested in learning more. And then prohibited transactions, who you can and cannot transact with when it comes to your retirement account. So a prohibited transaction is a transaction between the plan and disqualified person. And my next slide is going to show you who is disqualified, but essentially it's going to be the IRA holder, their spouse, parents, grandparents, children, grandchildren, and then any parents or business entities of those. So meaning that my IRA cannot lend me money. I cannot lend money to my spouse. I can't lend money to my children or my parents or grandparents. I can't lend money to my son's business, for example. All of this would be considered prohibited, even if it were at fair market value. You want to be aware of these rules. And sometimes people say, well, it's my IRA, but the IRS wants you investing this money for your future retirement, right? And so they're saying, hey, you can make investments as long as there's no current benefit to you or one of these disqualified persons or entities. So if I lent money to the business that my son works for from my IRA and they said, well, if you lend him money, then we're going to give him a promotion. Or if you lend us money, then we're going to give him a promotion. Then that would be a benefit to my son, and therefore it is a prohibited transaction when it comes to my IRA. But let's say my friend comes to me and says, hey, I'm starting a business, I'm raising capital, I'm looking for private money lenders, I'm paying 10%, would you want to lend to me? And I say, you know what, that's a third party transaction. I don't have any current benefit from it aside from growth in my retirement account, then that might be an investment you can do. And then on my last box here, we're going to talk a little bit about tax and when it applies, and I'll have an example of this later on, but unrelated business income tax is a tax that applies to retirement accounts or qualified funds when business activity or business income is going to be returned to the retirement account. And so typically investments are going to be passive. And so those investments would be generate things like rental income or interest income. But every once in a while you invest in a business where you're actually getting a share of the business profits, and therefore unrelated business income tax may apply. When does it apply? What does that look like? Those are really good questions for your accountant. Not something I can answer here, but just be aware that if your investment is not just receiving a passive type of income, it's something to talk to your accountant about. And then the second time tax applies to a retirement account is unrelated debt financed income tax. And this is when an IRA, an HSA, an ESA purchases property and uses financing to do so, or invests into an entity that's buying real estate with financing. And we'll talk a little bit more about this, but ultimately, if you're making an investment into real estate, either directly or indirectly through your retirement account, and that real estate is going to be financed, you're going to be exposed to unrelated business income tax or UDFI. Or if you're making an investment where you don't have passive income coming back, it's business income, then UBIT is going to apply. Now, the only exception to this is the 401k. A 401k is not exposed to unrelated debt finance income tax when purchasing real estate with financing. It does apply in the other scenario, though, so just be aware of that. We had a question pop up on UBIT. Generally speaking, for real estate investments with rental income or profit from the sale of a property, this is not UBIT. That would be generally correct. I'll give you an example. If I buy 123 Main Street and I buy it all in cash, this is very important. I'm buying it all in cash and I hold on to it. Let's say I hold it for 5 years and then I sell it. We're not talking about UBIT here. But same scenario, let's say I buy 123 Main Street and rent it out, but I purchased it with a down payment and financing, then UBIT does apply here because of the financing. So that's the important key. And I'm going to get, my IRA is going to get some deductions here. Again, speak with your accountant, but ultimately it will owe UBIT every year that I hold financing on that property until the financing's been paid off for 12 months. I will have to do that calculation and have my accountant help me with that form and have the IRA pay that tax every year, again, until the financing is paid off. I had another question pop up. If you decide to lend a friend money for their business, what documentation do you need? Usually what I tell people is the documentation that Advanta will need to see is anything that pertains to the investment. So if this is a note, an unsecured note, for example, then we need the originally signed note sent to our office and in our custody prior to sending out money. We want to see on that note that the IRA is the lender, and if anything else would apply to that note. So let's say it's a convertible note. If you're not familiar with that term, it's when you lend money and at some point what is owed to you could be converted to shares into the business. Then we need to see all the documentation that would apply in that case. So, it's better to send over too much and us say, okay, we didn't need this or that, but typically anything involved in the transaction is going to be kept on record by us for your retirement account. I had a question pop up, would depreciation offset UBIT? That's a great question. Maybe I would check with your accountant. You do get to take deductions. I think depreciation is also going to offset it, but I'm not an accountant. I'm not comfortable answering that question. Do you have to hold the property a certain amount of time before selling? You do not, but if you're doing fix and flips in your IRA account, then this is a good time to get your accountant involved again and get their opinion on whether or not fixing and flipping in your IRA is actually going to be considered business income and therefore, yes, trigger UBIT. So that's a question for your accountant. That's not something we can answer here. Sometimes an accountant will say if you're, just doing 1 or 2 a year or whatever, number they feel is appropriate, maybe that's still not considered business income. I'm just really not sure there. So I would defer to your accountant and say, hey, this is what my plan is. What do you think about unrelated business income tax? I had another question pop up. Okay, so I had somebody ask me a question about being a retiree and whether or not you can still open a retirement account and lump fund that's for savings, and what other suggestions are there for retirees in opening retirement accounts. So you can't lump fund a retirement account, so to speak, but there are ways to make contributions as long as you're eligible. So what makes you eligible is that you have earned income for the year that you want to contribute. And then how much you can contribute is going to be dependent upon the type of account that you have and how much earned income you have. So if you set up, let's say you wanted to make a contribution to a Roth IRA, and this year you had earned income in the amount of 10,000. Well, as long as you had earned income, you can establish a Roth IRA and you can contribute the max, which is 7,000 or I think 8,000 if you're over the age of 50. And I do have to double check that because it just changed over to 2024, and they did update the amounts. But so for the Roth IRA, you would be able to fully fund it as long as you were eligible. Now, if you're like, well, hey, I had a lot of earned income, if you're still working full time and you're like, I own my own business or I'm an independent contractor, there are still those other types of plans that we talked about, the simple IRA, the SEP IRA, the solo 401k that allow larger contributions on an annual basis where you can sort of lump fund those accounts as long as you had enough in earned income. So if you had, 50,000 in earned income this year and you wanted to get it into a retirement account, it's possible to maybe get close to that amount with maybe like a solo 401k, but it does depend because these account contributions are going to be based on a formula of your income. So that's a great question, and I'm happy to talk offline with you about it further if you'd like. So please feel free to jot down my contact information and reach out to me, and I can go over those types of accounts with you. And anybody else on the webinar today, we do have webinars on just the self-directed basics. So making a contribution, who is eligible, what the max contribution is for each account. And I'm happy to share that with anybody who would like to send me an email. I'll get that information out to you. A question popped up, can I use an IRA to pay off a personal car loan? Unfortunately, no, you cannot. That would be considered prohibited. So remember how we talked about transactions, on this slide and who is considered disqualified. And let me go one more slide forward. So you can see here, disqualified persons. This is the IRA holder here. And remember, a prohibited transaction is going to be a transaction between the IRA holder and, or the IRA and anybody considered disqualified, including the IRA holder. So a transaction is selling, leasing, lending, buying, transacting, providing goods or services. And so that type of transaction would be considered prohibited. So you can't lend yourself money or pay off a car loan for something that is considered personal. Remember, the investment, the purpose of these accounts are investments for investment purposes for growth for retirement. A question popped up, is there a maximum you're allowed to lend, and are there restrictions on the repayment? There isn't a maximum to lend. So similarly to there's no minimum either. If you're making an annual contribution this year and you find somebody that you can lend that money to and have interest earnings go back to your IRA account, absolutely. And if you have $1 million in your IRA and you're going to lend that money maybe on a property or to a business or whatever you would like, you certainly can do that. And there is no requirement for repayment. So I've seen single payment notes where literally that note is held for 5 years until it's due, and then it's done in a single payment. I've seen quarterly payments. I've seen monthly payments. So it's completely up to you as the IRA holder. You get to make that determination. A question popped up just for clarification on establishing an IRA with earned income. You can't fund it from your savings account. Unfortunately, you can't fund it from your savings account if you don't have earned income. So you do have to have earned income for the year you plan on contributing. So that is an important designation there, is that you have to have earned income in that year to make the contribution. So as long as you had enough in earned income, then it could come from your contribution could come from your savings, but you do have to have earned income in order to make a contribution. I had a few more questions pop up, but I'm going to move on for just a minute here, guys, and then I'll come back to questions, but please do keep the questions coming. These are great. And so we talked about disqualified persons and prohibited transactions. So again, just keeping in mind that you're really making investments for investment purposes. And just based on the last question, we talked about how selling, exchanging, or leasing property, lending money, or extending credit, furnishing goods and services or facilities between your IRA and somebody considered disqualified would be prohibited. So no self-dealing and no personal use of your IRA. Those are very important. So now we're going to talk about private lending basics. And we said at the very beginning that although typically when we think of a mortgage, we think of a standard mortgage, something typical, a 30-year note repayment, usually with a first position lien on a property, and it's paying usually principal and interest with every payment made. And we do see IRA accounts make those types of investments. But there are other types of lending that we see as well, short-term and transactional funding, something that's not secured at all. It's just a promissory note with an individual or a business promising to pay. And this might not be an investment that everybody's comfortable with. But again, doing your due diligence, if it is something that you're comfortable with, you certainly could make that investment. We do see loans with equity participation, and I have an example of that in case you're not used to that terminology. And then notes secured by things aside from real estate. So secured notes on things like farm equipment, automobiles, livestock. I've even seen things like ATM machines and large format printers. And so if it's something where you could potentially put people on notice that there is a lien on that equipment or whatever it might be, then that could be a loan you could do. But remember, you can lend money unsecured. So if you're comfortable with that type of investment, you certainly could do it. The really cool thing about private money lending within a retirement account is you get to be the bank. So think back to the title of this webinar. You get to determine the amount you're going to lend, the interest rate, the length of term, if you want equity participation in the investment, what the repayment terms will be. And so think about when you've gone to the bank and borrowed money, maybe even for your primary residence or for your car loan. They say, hey, this is what we're willing to lend you. This is how much time you have to pay it back. And this is the interest rate we're going to charge. And sometimes you're like, okay, I'm going to shop this out, or maybe that's the best deal and you take it. When you get to be the bank, you get to make set all of those rates. And so it's going to be completely up to you on how you want to lend that money. And the really cool thing about being the bank with a retirement account is you are basically setting the rate at which your IRA is going to grow. I like private lending. That's what I do with my self-directed account. I like to sort of be in charge of what I am willing to lend and how long it's going to be out there. And so when you're talking about private lending, and really with a self-directed IRA in general, you are in control. And when you decide, if you decide that you're going to be the bank, then you're going to act as the bank in that sense. So when you decide how much you're going to lend, how you want to lend, what security you want, if any. And if you want to invest in real estate, it might be a way to get involved in real estate without dealing with tenants, toilets, and termites, right? There could be less liability than a real estate investment directly, where you're actually holding title to a property in your IRA. It can be very low maintenance as long as your borrower is paying. And you can partner funds among IRAs and individuals to put money together and have more buying power, so to speak, when you are lending. And so now we're going to talk about some case studies, but before I go on, I'm going to look at the questions again. I know I had quite a few. Keep those questions coming, guys. What about a checkbook IRA? How can you still fund it? So you can still make your annual contribution, but you do it to the IRA first. So if you have checkbook control, essentially you're using an LLC or a trust to control your IRA money through that entity and make investments, but you do still have to make your annual contribution with your IRA custodian or third-party administrator. So if your account is with Advanta, you're going to make your annual contribution with Advanta and then ask Advanta to move that money over to your LLC or trust. That's very important because remember, we're doing your IRS reporting, so you want us to log that contribution. You do not want to make your contribution directly to the LLC or trust. I had another question pop up. My understanding is that I can take a loan of up to $50,000 per year for a personal loan from a retirement account and pay it back. Is that correct? That is not necessarily correct. That is only true of a 401k, not an IRA. And you can take 50,000 or 50%, the lesser of the two. So if you have 20,000 in there, you can borrow 10,000. And this only is going to apply to 401ks. It does not apply to IRAs, HSAs, or ESAs. So please be aware of that. Because in the 401k, of course, that's a loan to the participant of the plan and is not considered prohibited. But in an IRA, that would be considered prohibited. Can I buy a house for my brother in Canada? You potentially could. So when we talked about who is considered disqualified from your IRA, if you will notice, we did not talk about brothers, sisters, aunts, uncles, and cousins. Those individuals, because they're not directly up and down your lineal tree, are not considered disqualified necessarily. But this is where you want to be really careful, because if this transaction or investment has any intrinsic value to you, any benefit to you or disqualified persons, then it would become prohibited. So what does that look like? Well, let's say, I always like to use the example, let's say my IRA owned 123 Main Street and it was available for rent. And my brother said, hey, I really would like to rent 123 Main Street. I like the area, I like the house a lot. I saw what your rent is. I can afford that. Can I rent that house from you? If I said, okay, if you're going to be a good tenant, we'll sign a lease. This is what the fair market value rent is. This is when it's due. Then we're all well and good. But let's say that my brother couldn't rent anywhere else. I was thinking about giving him a discount on the rent. For example, if he didn't pay rent, I wouldn't treat him like a tenant. I would say, okay, well, you didn't pay rent this month. Just make sure you pay it next month. These are all considerations where that might look like an intrinsic value to me. And now it has become a prohibited transaction. And we at Advanta, we're not going to make that determination for you. But if you're looking at making an investment where this could become prohibited or there could be some intrinsic value to you for making that investment, we would strongly urge you to talk to an attorney that can help you understand whether or not this investment would be okay. And, you know, if it were looked at it by the IRS, would it be something they considered prohibited or within the rules for self-directed IRAs. I had a question about HSAs. My understanding is I can't contribute to pre-tax since I'm no longer with that employer. Can I still roll this HSA and self-direct it? The HSA account is actually dependent upon your healthcare coverage. So you could contribute if you had a healthcare plan that allows contributions to an HSA. So the plan itself has to allow the contributions. But if you're no longer able to contribute, yes, you can grow the HSA. You just can't make those contributions. So you can still self-direct it and have growth in that account. There was a question here about if you already have a self-directed account, how do you start lending? You don't need an LLC. You can just start the lending process. And we're going to go through some examples here that I think will really be helpful to see what that process looks like. You can use an LLC, but you don't have to. You can go directly through the retirement account. And there's a couple different ways that you can look towards doing the lending and the loan servicing and things of that nature that we'll talk about. Does Dodd-Frank apply? If Dodd-Frank applies, then it applies also to the IRA. So keep that in mind if you're looking at lending money where Dodd-Frank will apply. Again, it's probably a good time to get attorneys involved to help you with that transaction. I had a question on fees. I'm really not going to go into fees today, but you are certainly welcome to send me an email and I can get that information over to you, or check out our website. It is on our website. Had a question about private money lending versus purchasing a rental. So it sounds like you're asking about a down payment here. So private money lending versus buying a rental. What if you don't want to use 100% of the funds to purchase the rental so that you have money available to lend? We're going to talk about getting a mortgage and an IRA, and you can do it. There are some moving parts, so I'll go over that shortly. If you have money in a Roth IRA and you want to do private money lending, do you have to have an LLC? You do not. You do not have to have an LLC. As a matter of fact, I don't think any of the examples I have here today are going to use an LLC. So you can, and we do have a whole webinar on using an LLC or trust for checkbook control, but we do not require that. You do not have to do it that way. How do people pay back the loan? They're going to pay it back to the IRA directly, and we're going to talk about that. What if people don't pay it back? That's going to be a good time to get your professional team involved, talk to an attorney, find out how to get repayment. If you have security, meaning either an asset or real estate as security for that loan, again, talking to an attorney, getting them involved, and even if it's unsecured, having somebody help you understand how collections work. Any webinars that anybody has missed and is interested in, you can check out our YouTube channel. Just search Advanta IRA. They are all archived there, and they're also on our website under our video library. Thank you so much, guys, for the questions. I'm going to move on now to the case studies, but if you have more questions, please get them typed into the chat box. So this is just going to be a typical mortgage. The biggest difference here than something you would maybe be familiar with is this is going to be a loan to an investor. So instead of lending to somebody who's going to live in a property, in this example, Paul is going to lend money to an investor who is purchasing a rehab or maybe a rental. But Paul decides that he wants to move $120,000 over to Advanta and meets a private mortgage broker who can help him place IRA funds into a first mortgage. And there's lots of different ways to find loans available, but just keep in mind that Advanta does not put borrowers and lenders together. So that's just simply not what we do. But you can talk to a private mortgage broker. You can do networking at local meetings like we do. So there's a lot of real estate meetings all over the country, making sure you're just comfortable with the investment that you're making. Know the borrower, vet the investment, and feel comfortable in the transaction that you're doing. So Paul meets a private mortgage broker. He lets the broker know what he's looking for when he lends out money. The broker presents him a loan. He decides that he is going to agree to purchase that loan or make that investment, but first vets the property and the borrower. And that's important. Remember, we're not doing your due diligence for you. So in this case, Paul is going to look at the property, make sure that he feels that whatever the loan to value is, he's going to be in a comfortable position where he feels comfortable, so that if his borrower stops paying, he can recoup his investment. The loan amount in this example is $120,000 at 8% with a 5-year balloon. The monthly payment is $800, and he is happy with security on a first mortgage on the property. So everybody's responsibilities are outlined here. Paul is going to open and fund his Advanta IRA. He finds the loan. Remember, we don't put borrowers and lenders together. He makes an offer to lend on his own terms. So somebody might say, hey, Paul, I'm willing to borrow your $120,000, but I want to pay 6%. And Paul says, I'm looking for 8%. That's what I want to lend my money at. So they come to an agreement. Remember, Advanta doesn't do those negotiations for you. Paul informs Advanta about the terms and reviews and approves all documents. Advanta does not provide any legal documents for the investment that you're making. And so Paul is going to bring the note and mortgage to us in this case. And in this case, because he was working with a private mortgage broker, he probably did get those documents from the private broker. But if you're just going to lend money to an investor that you meet or a friend that you meet or whatever, then you might want to get an attorney involved in order to help you produce those documents. Advanta will review the documents, but only to make sure that the lender is properly titled. So in this case, it would be Paul's IRA. So Advanta IRA Services, LLC, FBO, Paul's IRA number 1234. We put all the documents into a DocuSign for Paul, and we add 2 forms that give us permission to make the investment on Paul's behalf, and also for Paul to complete and let us know who we're dealing with in this transaction. So for example, is there a closing attorney, a title agent involved? When does the funding have to take place? What to expect, any closing instructions we need to know. And then the mortgage is recorded either by the private mortgage broker, by the title company, by the closing attorney, and sent back to Advanta. And we keep those documents in safekeeping for Paul, and the investment is complete. After close, the borrower sends monthly, and in this case, they are interest-only payments back to Advanta. And remember, somebody asked the question, what are the repayment guidelines? What does the IRS require? And so this could be a single payment note. This could be amortized principal and interest payments over 5 years, 10 years, 30 years. It could be interest only for 5 years with a balloon, which is what this example is. But ultimately, Paul is going to let us know what those are. But he's also going to keep track of payments made, because when the borrower sends in the payment, if he's not using somebody to service the loan, Advanta IRA is not making sure that those payments are on time or complete. So it'll be up to Paul to make sure that he's checking his statements or following along with his email notifications to make sure he's receiving the payments that he's hoping to in the amount he's hoping to. Now, if Paul is worried about whether or not those payments were received on the 1st or by the 5th, then he might want to either use a loan servicing company or have those payments sent to his PO box or whatever. Still made payable directly to the IRA. He can't deposit those funds to his account. But if he's checking off in his ledger to make sure those payments are received, then he could do that, because Advanta doesn't look for those payments on any specific date. And if it was received on a Thursday and deposited on a Friday versus the 1st or the 2nd, we just don't keep track of that. But when payments are received, they are deposited in a timely manner. And then we notify Paul by email that they have been received and deposited. 3 years later, the borrower decides to sell the house, and Paul's IRA receives the $120,000. Remember, this was an interest-only note. So we receive $120,000 at the sale back to Paul's IRA. He made $28,800 in interest during the life of the loan. And now, because the money came back, Paul is ready to make a new investment, and it doesn't have to come back in 3 years. It can come back in 5. They can agree to extend the note. It can be paid early. There could be prepayment penalties, and the borrower could even pay all of Paul's Advanta IRA fees. So there's a lot of different ways to structure these loans. I had a question pop up. Can you take monthly distributions of interest income taxable, of course? And the answer is you could. The money first has to come back to Advanta, deposited to your IRA. You request the funds as a distribution. And then, of course, they're going to be taxable dependent upon the type of account you hold with Advanta. So if you have a Roth IRA, of course, those distributions, as long as they're qualified, are going to be tax-free. And if you have a pre-tax account, then it's going to be considered ordinary income the year you distribute. In this next case study, we're going to talk about an equity partnership. And in this example, Andrea and Steve are going to work together on an investment that Steve is making personally. So Steve is personally going to purchase a property and rehab it. And remember that you can't provide sweat equity on an IRA investment. And Andrea says, I really want to be a part of a fix and flip, but because I can't swing the hammer myself, I want to get involved in a deal where I can be the passive investor. So Andrea meets Steve, they agree to partner up, and instead of just lending money, she wants a piece of the equity upon the sale of the property. So she's going to do her due diligence with the property and on Steve and make sure she feels comfortable with the investment. And she's going to require that Steve put some money in this example, and she's going to put some money in. And so the loan amount is going to be $125,000 at 5%, plus Andrea wants a third of the profits on the upside. So when the property sells, she's going to get a third of the profits, and this is a 2-year balloon. You have monthly payments here, but again, in referring back to that question, if she says, you know what, I don't need any payments, I just want, my 5% growing and a third of the profits, and it can all be paid in a single payment, then that is completely up to Andrea. She can make that decision. Her attorney is going to prepare the note and mortgage. She's going to sign off that everything has been approved by her, and then we make the investment on her behalf. When Steve's ready to sell the property, he requests a payoff amount, and Andrea is going to provide that to Advanta, and then we can certainly provide it where it needs to be provided. The payoff letter is sent to the title company, and all parties are working together for the closing. When money comes back, it's going to go back to Andrea's Advanta IRA account. So the repaid principal in this example is $125,000. The monthly payments over the course of the time of the loan were $3,000, and her share of the profits were $25,000. So total earnings were $28,000. And then we like to show Steve's side of this as well, because I do have people who raise capital and work on fix and flips and invest in things like mobile home parks that don't necessarily have an IRA with us, but they refer their investors to us because they see that knowing about self-directed retirement accounts is just a tool in their tool belt, because they might say, I always borrow money from Andrea, but she's 100% funded. She doesn't have any other funds. But hey, Andrea, did you know you could use an IRA to invest with me? And now all of a sudden, a whole new world opens up for Andrea where she says, I didn't know I had access to those funds for that type of investing. And so in this example, Steve originally borrowed $125,000. He sold the property for $200,000. He repays the loan and the interest, and he had a total earning of $47,000. Using non-real estate for collateral, you can do this. We talked about different things, right? Like automobiles, farm equipment, even we've seen loans collateralized by different types of farm animals. And if that note is secured by something other than real estate, just making sure again that you talk to an attorney and have them talk to you about how you put someone on notice, or how you put the public on notice that that equipment has a lien. So understanding UCC filings and how you kind of track those payments and what happens if your borrower doesn't pay. Also, if you're lending on non-real estate, or if this is going to be something related to business income, if UBIT would apply. So again, non-real estate for collateral will work, just being familiar with how it's going to work within your retirement account. So case study number 3 is unsecured lending, and I know we talked a little bit about how it does not have to be secured by real estate or non-real estate. And we sometimes do see unsecured lending to businesses for, startup companies. Sometimes these are convertible notes, but not always. And so in this example, Tom has $50,000 in a SEP IRA and has a friend who wants to expand his business and needs short-term capital. So Tom decides to lend the money without collateral. Tom drafts the unsecured promissory note listing his IRA as the lender. The borrower pays the note, or the borrower signs the note, and they mail it to our office. Remember, that signature is sort of the debt instrument, and so we need the original wet signed note at our office prior to funding. In this example, the loan amount is going to be $50,000 with an interest rate of 10%, and it's a single payment note due at $55,000 in 1 year. Special considerations, again, because there's no title company or attorney involved in this one, we must have the originally signed note. Since it's unsecured, lending is riskier than conventional mortgages because it's not secured in the public record, and the interest rate tends to be a little higher. Think of like your credit card. Make sure you know your borrower, because it could be difficult to recover if there is a default. And the last case study we have here, we're going to be talking about how an IRA can actually borrow to buy real estate. And we talked about unrelated business income tax and how it does apply when you're using financing to invest in real estate. And that's true whether your IRA is investing directly, if your IRA is investing into an entity or using like an LLC or a trust, or if your IRA is a limited partner or subscribing to a deal, if there is real estate being purchased with financing involved, unrelated business income tax is going to apply. Now remember, 401ks are going to be exempt from unrelated business income tax for financing real estate, and that's like the only exception. So Mike's real estate deal, he has an old 401k worth 160. He finds a house for 150 that doesn't need work. And Mike decides he's going to use 60,000 from his IRA as a down payment and finance the rest through a non-recourse loan so he can buy 2 properties. So he feels like he's increasing his buying power here. But note that specific terminology. He's going to use a non-recourse loan. So remember, you can't extend your personal credit or give a personal guarantee for a loan when your IRA is involved. So very important, it has to be non-recourse. There are non-recourse IRA lenders out there. You can reach out to us for more information or a list of private money lenders and institutional lenders that will do non-recourse, or you can of course look it up on the internet, and there are a few that will pop up there for you, but remember it has to be non-recourse. 90,000, the loan will be for 90,000. It's a 6% fixed rate loan at 30 years with a monthly payment of $540 and annual payments of $6,500. And that's important because we're going to talk about unrelated business income tax. So Mike cannot guarantee the note personally, and thus the bank can only foreclose on the IRA. The loan is to the IRA directly, which means the IRA is responsible for repaying the loan. Lenders for non-recourse typically want 30 to 40% down. Income received on the mortgage real estate is subject to unrelated debt financed income tax. Only income based on the percentage of financing is subject. So if you, let's say, for example, you borrow 50% to purchase a property, then 50% of the income is going to be subject to UBIT. And the IRA files IRS Form 990T and pays the taxes. So this is not a form Advanta helps you with. So you want to work with your accountant to file the tax form 990T and make sure the IRA pays that tax, but it can get deduction. And we do have on this slide depreciation. So going back to that question, deductions and depreciation apply for the 990T or for the taxes. No 990T is necessary if the total UDFI liability is less than 1,000, and tax is paid at trust tax rate. So I don't know what that is right now, but 37 or 39%, something like that. So it's high. So it'll be important to understand if you can get deductions and depreciation and when and what that will apply to help you offset this tax. Here's an example of the calculation for you, just to kind of help you understand how it works. So total monthly rents, remember it's related to the income. So that's the income related to the debt. So with financing and with an all cash purchase comparison, $24,000 in each. Loan payments, $6,500, of course, doesn't apply to the all cash purchase. Expenses, $6,000, expenses $6,000. Net prior to the tax, $11,500, and remember this is less those loan payments here, where on the other side you have $18,000 because there were no loan payments. The income subject to tax is $6,900 based on percentage of ownership, and then the tax paid at 28% in this example without deduction and depreciation. And so you can see it does not necessarily mean that the investment would not be worth it. It is definitely something where you want to make sure that you are doing these calculations and you feel comfortable and understand that loan. So here's the steps to get started. I'm going to leave this slide here for you, and while I look at some questions that I see popped up here. Can my Advanta IRA buy a house and then sell it and hold a mortgage? Yes, absolutely. You can definitely do that. The IRA will buy a property from an unrelated third property and then sell it on terms. That will work. If I wanted to loan a rehabber who needs funds to fix up 3 properties but already owns properties free and clear, would my IRA issue a promissory note in addition to a mortgage or lien on the property? Would it be a new mortgage or lien? So these are really good questions for an attorney, but typically when you're lending money for the rehab of a property, we would typically see that as a note and mortgage, and the mortgage is the lien on the property, and it could be a first mortgage, it could be a second mortgage, it could be a third mortgage. But when you have questions about the types of legal documents needed in order to lien a property, this is where I would get a title company involved, or closing attorney, a real estate attorney, somebody who can help you with those documents. That's going to be very important, because not only can they put those documents together for you, but they can help you make sure that they properly get filed in the public records so that you do properly have a lien. Because if you create a mortgage and you never actually file it with the public records system, the lien doesn't technically exist. So it's important to understand that. What about people who fail to pay property taxes? So that's a tax lien, and you can buy tax liens in your IRA. I think that's your question. And so certainly tax liens can be purchased. You would do that through the county, decide what counties you're going to purchase liens in, and find out about their process to buy those liens, and then talk to your Advanta IRA account manager and let us know what you found out with the county you want to invest, and then we can explain further how to make that investment. And sometimes people do use LLCs and trusts to ease the management of investing in tax liens. It's not required, but it's something that we do see a lot. There was a little more question on that. What are the risks of investing in tax liens? So I would definitely recommend doing some more due diligence on that, and making sure you understand how tax liens work. And then tax liens are also going to be specific to the state you're investing in, whether or not you're investing in a tax lien state or a tax deed state. And there are some differences there that I'm not going to go into right now, but if you have more questions on it, please feel free to reach out to me and I can go over that with you. If I want to purchase an investment property using funds directly from my IRA, do I have to have an LLC? You do not. If there's a legal reason you would like an LLC, I can't discuss that with you, but certainly you can work with an attorney, and I can refer you to attorneys that have helped our clients set up LLCs in the past. If you have an LLC as the IRA, the LLC listed as the lender. If you're using an LLC and all of your IRA funds are in that LLC, then the LLC is listed as the lender. The IRA, or excuse me, the webinar is being recorded. So if you are on and listening right now and you missed the beginning, or you missed the end now at this point, because you've already signed up, you are going to get the recording. So you'll be able to get the recording for this webinar, and you can revisit it, or you can share it. Remember again, guys, that Advanta doesn't put borrowers and lenders together, so that's super important to remember. So if you're looking for opportunities to borrow or lend, make sure you're doing your networking. You can connect with private mortgage brokers, talk to your peers, and find out how they're connecting with borrowers and lenders, and hopefully that's helpful to you. Checkbook IRAs are also subject to unrelated business income tax and UDFI. Yes, the entity does not shield you from that tax. There are ways to mitigate that tax. So for example, if you've ever heard of the term C blocker, or using a C corporation to change the taxation on an investment, you could potentially do that. Again, I am not an accountant. I'm not comfortable going over that process with you or what that looks like. So I would suggest talking to your accountant about that and see if it makes sense for you to use a strategy like that. How long does it take to move from a 401k to Advanta? It does take a little bit of time because typically 401ks will only mail a check. And so you want to reach out to your 401k plan administrator and find out what their process is. Now, certainly if they would send a wire, we would accept it. But typically 401ks are only going to mail a check, and they'll have forms for you to complete. Sometimes they'll want those forms to have your original wedding signature. Again, it's all going to be dependent upon the plan administrator. I had one more question pop up, and then we're going to wrap up today. I know we're a little bit over our time here, so thank you for sticking with me, guys. How do you ensure that the property taxes and real estate insurance are being paid by the borrower? And I would really defer to an attorney on this one. They can help you understand what that process looks like. You can also talk to a loan servicing company. I think they would be well equipped to answer those questions for you. And you could even engage a loan servicing company to help you with that and make sure that all the payments are received on time and that you're receiving the amount you should, if you are trying to make sure that the property taxes and insurance are being paid. I do not see any other questions pop up. Here are just some ways to get in touch with Advanta and stay connected with our education. We have events. webinars going on all the time. We also do have our own networking event at the end of every month, last Friday of every month. It's on Zoom. It's called Pitch, Promote, and Prosper. You can check out our website to register for that. We have our video library where we're going to archive all of our webinars, including this one. And we do have a blog where we keep up to date with the latest industry news and how it pertains to us. Again, my name is Larissa Greene. I thank everybody for attending today. This webinar recording will go out either at the end of today or tomorrow for you to revisit and share. Please feel free to reach out to me directly with any personal questions you may have on starting a self-directed IRA or any of the information we talked about today. Thank you so much for joining.